Hello, everyone. Welcome back to the channel. This is Fair Value Finder, and today we are taking a look at VF Corporation, ticker VFC. This is another clothing conglomerate. They own Dickies, the North Face, Timberland. I do like Timberland. Supreme, Vans, JanSport, Kipling, and a few other brands. They used to own Nautica, but they sold that off, and a lot of others that I'm at least not familiar with. But there was a comment on my Birkenstock video saying that if I like Birkenstock, then I probably would like VFC. So I figured I'd take a look, and I don't like this stock. At least not with how things stand today. They do have some future potential, possibly, but coming up with a fair value of $16.45. Actual value, $16.60. So right around the fair value. Discounted cash flows, $18.69. They are losing money right now. And it looks like things are finally going to normalize in about 2 years, according to analysts. So I really am not even going to consider this for another 2 years. We're coming in with a negative earnings yield of negative 14.5. Cash flow yield decent. We'd like to see that higher. It is higher than it has been historically. Usually 12.8 came in, or usually 2.8 came in at 6.8. They do pay a dividend. They did cut it recently. That's usually a big red flag. Something like that, we'd want to see them stabilize, maybe even start raising it again before we even consider getting back in, because that is catching a falling knife, kind of a yield trap. So you can see that usually they're coming in around 3.6% yield. Now they cut it down to 2.2%. Payout ratio, negative 32.9. They cannot afford that dividend, even though it's lowered. ROE, just absolutely losing money across the board. Debt to equity, balance sheet is in a terrible position. A 6, we like to see that at 1. Margins look decent, though. Almost 52% gross, a bit lower than they have been historically. And then net. Over this last 5 years, they've been getting absolutely destroyed, just losing money, coming in on average 2% net, negative 2% net. This last year, negative 11. Rule number 1 for me is don't invest in a company that's not profitable. So this right here is the biggest red flag, and it will not make the watch list or even be considered probably for another 2 years. I mean, the most reasonable case here for our thesis, absolutely flat on revenue. There's no growth expected by analysts over the course of the next 2 years. Share count, they are issuing shares. Big red flag there. Cash flows are on the decline consistently. They did come in with a higher yield than usual, so I'd expect a continued decline, and even a 3.5% decline would take them down to 5.7% over the next 5 years. So there's still even more room for that to go down to get back to their almost 3% average. Assets on the decline. Liabilities, they did grow a little bit over the last 2 years, but they have paid them down pretty nicely in the last year. So we will go with similar growth/decline in the assets and the liabilities. Dividend, they're definitely not going to be raising that. Hopefully they don't cut it anymore. And margins, I mean, I don't see this getting much better. I have to put in that negative because we're starting with a negative. Maybe something like this is a bit more reasonable. Bringing them to negative 7%. Again, I don't know where the floor is for this thing. It's catching a falling knife right now in my eyes. Now, there are some investors who may see it as a potential turnaround opportunity, but I don't look at things as a turnaround until they start turning around. And right now, the declines are continuing from what analysts are projecting. So if you're buying in right now, you're right about at the fair value, but you're not getting really any growth. A bit of a dividend, so you're coming out 2.8% per year. And in that case, you're underperforming the market by 6% in 3 years. That's not too bad for what we're looking at. But in the 5 year, we're talking about a 28% underperformance of the market. So we can take a quick look at everything, see where all the valuations are going, and I mean, a lot of things are just trending down. So we'll start with the lowest here is earnings. They did have a huge dip, hopefully coming back. Analysts are expecting some sort of positive over the next 2 years, fixing those net margins a little bit. But the revenues are staying flat and declining a little bit. Cash flow is the next lowest we have here, coming up to a peak in 2022, slowly going down from there. And then we have the actual fair value of the stock, correlated mostly with the balance sheet, it looks like. It looks like those two have been switching positions, staying pretty close for a while, which at this point in time would put the decent value to pay for this stock around $12. But with how things are trending, that $12 is going to decline over the next year to 11.5 because they're selling off assets. And they already are starting with a very poor balance sheet with a 6 debt to equity. And then we have the actual share price, which hasn't really been correlated with reality for a while. Looks like it was insane back in 2021 and got cut way down from that peak up until 2023 and is slowly descending down to where it sits today, which again is right about at the fair value. But like I said, it'd really be best to get into this thing closer to 12 if it is something that you're trying to get into. The dividend was holding pretty steady up until 2022, and then they started to cut, and then they cut again, and hopefully they don't have any more cuts. But I mean, ideally they really do because they're not running at a profit. They have a negative payout ratio. They're just harming their business, issuing shares, harming their investors. So it's just a whole mess here. Definitely every mistake that I've made in my investing journey with a stock, I see here in this one. So hopefully you guys don't end up making mistakes like that. Can we come up with a better scenario here? We can try. I don't think that there's a much worse scenario here. Hopefully, realistically, the worst is what's happening right now. But let's just say we see revenue declining at rates of somewhere between essentially 2 and 4.5%. So let's say they can go against what analysts are projecting and grow it somewhere in the realm of 3%. Share count, they've been consistently issuing. I don't think that we can really change that. Cash flows, let's put that in line with the revenue, hold at the current yield. We'll give them the benefit of the doubt. Slight growth over revenues as they improve their margins. Assets, I mean, if they can just stop selling them off, hold flat, that's probably a decent scenario here. And then liabilities, I mean, I'd like to see them come in at that -5. Based on what they did this last year, I feel like it's pretty realistic, but we'll see what happens. Dividend, we're going to hold where it's at. Margins, we'll do something a little bit better than that realistic scenario. I mean, I'd love to make this positive over the course of the next 5 years. But when you're starting with a negative number, the math for that is not easy to do. So here, this will give us a break-even operation. And in this case, things don't look as bad. You're buying in at today's price, and you're outperforming the market because you're getting returns of 11.1%. Beating out the market in the 3-year by 22% and in the 5-year by, again, 22%. And this is the best case scenario. But again, that's a gamble. That's a roll of the dice. Things are not looking hot right now. Debt to equity, net margins, earnings, not looking good. I'd like to see some sort of turnaround before going into a turnaround play and not just catching a falling knife. But this is one where if they can get back to their glory days, get back in line with something that we saw in 2022. Now, the valuation was absolutely inflated at that point. I don't know what kind of growth the market thought it was going to hit. This is the type of scenario that I'm seeing with stocks like NVIDIA, where there's just unreasonable expectations set on the company. And when they don't hit it, they sell off. Like back in 2022, the share price was at an all-time high, but the fair value is actually lower than it is today because their cash flows were atrocious. And cash flows are one of the main things that they do actually have going for them. So maybe that's a bit of an outlier year. But then the next year, everything seems reasonable aside from earnings. There's always something that's not going right for them. So I guess 2021 is kind of the best year here. And 2024, we're not all the way through, but based on our expectations, this is what we're looking at. Pretty spread out in 2021. Fair value of about $44. Actual share price of about 70. So very overvalued at that point. And I will say today looks like the most reasonable time to buy out of the whole time frame. But when it comes to the market, I am an investor, not a gambler. So I don't see what I'm looking for here. I wouldn't say it's necessarily a company to just sell out of and give up on. There is potential for a turnaround if you own shares. I wouldn't be buying up too many shares personally, but it is at a somewhat reasonable price. So I want to thank you guys for watching. Please like if you enjoyed the video. Comment what other stocks we should take a look at and subscribe so you can stay up to date with everything. And I'll catch you next time.